All right, we're going to take a quick break and get into Martin's Pro Picks. This segment is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer. It offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, Martin, you alluded to this one, but you sold Suncor. So normally we've got pro picks that are all buys. This one I like. You're talking about positions maybe you should look at taking profits. And the first one is selling Canadian and U.S. oil like Suncor. Talk to me about that strategy in isolation, because I know then you're doing something after the fact with proceeds.
We own, and also we sold some Occidental at a loss. We liked Occidental because of the backstop by Warren Buffett into the company. We sold our Suncor position and our capped energy index position. What we did was we redeployed that into a note, a U.S. dollar denominated note, because we want to make sure we get continued access to the U.S. dollar. When the dollar rallied the other day to near 70 cents CAD, we converted a lot of Canadian dollars into CAD. Whenever it gets to 70 cents, we'll do that. And then we did a U.S. dollar denominated note based on similar to the capped energy index, Canadian large cap producer. So we're kind of replacing the Suncor within that structured note.
So, but tell me, what is the view? Because if you're replacing it, why sell Suncor in the first place? What are the downside scenarios that you're trying to mitigate?
We got 40% downside protection now. I love that. I'm going to sleep at night. And if we get it wrong, okay, again, it's sort of like what happens if we're right? And I don't want to be right in this scenario, and tariffs cause the energy markets to poop the bed, and then these things are down. I mean, I've made a lot of money on these positions, a lot of money. We bought them when they were selling off during the COVID period of time.
Oh wow! So you've really held on for a while.
We've been riding it up and down, but we've done well last year and the year before. We've done really well on those names. We don't own the Baytex in a large size, and we're not worried about. I mean, that's been a trade. But our core positions have been C&Q and Suncor and the capped energy index. It's been beautiful. It's been a wonderful trade for us. We're quite happy about that. So we're selling and making some money, and we got to pay some tax, but the tax rate's not going up, and so now we're just de-risking that, and so now we own those names again. We got 40% downside protection, and we got 20% upside, albeit as taxed as income. But 20% upside per year. If it doesn't get called away this year, it got called away the next year at 40%. So a 20% return for a pension-like portfolio is outstanding. And so that's why we did that trade. So I'm going to be able to sleep at night if things go wrong, and if they go right, I'm going to make 20% for our clients.
All right, so let's put that view, how you like to invest, into context with the second idea, strategy, let's call it, selling the S&P 500 and going into U.S. value-oriented stocks. What's the call there? What do you think might happen? Where does this trade benefit?
Again, to the downside, you saw what happened to Apple and Tesla, and look at Google. I mean, I don't want to have that downside exposure. Now, keeping in mind, our portfolios didn't rocket like the S&P last year. We did really well. We met all of our goals on our targets. Our goal is to track from a balanced perspective, 80%, 90% of the upside, and protect 60% of the downside. So if that's our goal and objective, then with the S&P, we owned it. We made a 15% return in 6-7 months. Really happy about that. Do we want to buy it again at these multiples given the risks? So multiples haven't changed that much, but the risks, potential risks, like tariffs, are that much higher. So if the multiples were reflecting those risks, then yes, we would have rolled it back into it. Now, if you look at the gap between the S&P versus value names like Berkshire Hathaway, JP Morgan, Broadcom, those which are in a Vanguard value ETF that we bought, there's a big gap there. And so we want to own those names because if those names are trading at a substantial discount to the tech names that are exposed to the tariff risks.
And that value ETF is ticker VTV. That's always been such a debate, though. Is growth over? Is it back to the value trade? Do you really think that this is the year?
No, I told you at the very beginning of this interview, we're playing the trap. We're playing defensive. So we weren't trying to make that call 2 years ago. We're just looking at multiples versus risks, and there's substantial risks. And this is a safer trade. It's a defensive trade. We're locking in some good gains for the last 2 years, 2 periods, going into the third period with a safer trade. If we get 6-7%, we're happy about that.
It is a Canadian podcast, so we're nothing if we don't have at least one hockey analogy. So thank you for bringing that to us. Your third one is on the U.S. dollar. Buy U.S. dollar anytime the CAD, the Canadian dollar, is close to 70 cents U.S. Right now, where is it? Is it around that level?
I haven't looked this morning. Where are we at?
Yeah, 69. So you would wait until it hits a full 70?
I'd still do anywhere from 69 to 70 if you're underweight U.S. dollars.
And then what's the call there? Why are you doing that?
Again, defense. Let's just say the energy complex rolls over and there's no support for the dollar. The Bank of Canada has to cut more than the Federal Reserve. The dollar is going lower. And I mean, it's not going to, like, I've seen calls with a 5 handle. I mean, this.
On the Canadian dollar, to be clear.
Yeah, the Canadian dollar being, 55, 60 cents. That's just not happening. Although I'd like to say it's just to scare people away from voting from Carney. But it's not. That's not going to happen in reality.
Even if Carney gets in. Let's get you on the record on that.
I mean, he was a former governor, so he's got a close eye on that dollar and interest rates. And he's a smart guy. I mean, he's one of the smartest people, in the room. And that's also dangerous. So if he gets in and he imposes a climate change policy and putting climate change tariffs on imports and slams it with a production cap on energy, and OPEC decides to Russia gets a peace agreement with Ukraine, they hit the market with oil, and OPEC can't control prices, oil prices go lower. Yeah, we could see a 65, 60 cent dollar. I mean, all of those things have to come together.
But that's not your base case.
No. I'd be a buyer of Canadian dollar if it goes to 65 cents. I'd be converting. We have like 45, 50% of our total portfolio is in U.S. dollar denominated assets. It's been fantastic for us. But last year it was up 8%.
But it sounds like you wouldn't shift even more to the U.S. dollar denominated assets right now.
Just on that reprieve here, like when we're getting this 30 days, and if it goes to 70 cents, then 70 cents isn't reflecting the risks of the tariff threats. And there isn't going to be a huge move either direction. But that allows us to do some interesting things. As I mentioned about the value ETF, we did an option strategy in the Russell 2000 because people are so bullish on U.S. equities. We fully put protected downside, all the downside on owning the Russell 2000.
Small caps.
15, yeah, and so from now until November, we have no downside risk and capped 15% upside risk. And so we had to do that in U.S. dollars. So it's a great trade. And who wouldn't want to own U.S. stocks? I know it's not tech with 0 to 15% payoff profile. I mean, that's a no-brainer.